It will be the year of hell. I'm your host, Steve Van Metre, and thanks for joining me in the new year. In our lead story, legendary hedge fund manager Michael Burry is back with an ominous warning for investors that the worst is yet to come. Well known for his cryptic tweets that he often deletes shortly thereafter, this time Burry gives us a little bit more information, so we're going to take a look at what he says and see if he's right and when it's likely to happen. Let's over to Bloomberg, where he picked today's story up with the headline, U.S. is in a recession by any definition, Michael Burry says. Well, maybe not so true. Of course, the definition for a recession is a period of temporary economic decline during which trade and industrial activity are reduced, generally identified by a fall in GDP in 2 successive quarters. Now, of course, we know that we haven't quite had that yet, but we did come close. We had the first quarter and second quarter, but what happened in the third quarter is, well, if there was a recession, and by technical standpoint it was, right now there's no sign we're in one. And here you can see the GDP data. We note from the second quarter, minus 0.6% now, moving to plus 3.2%. Of course, the question remains is, where will the fourth quarter come up? And early data suggests it will be near zero, maybe slightly negative, could be slightly positive, but it is decelerating quickly. So the notion now from the third quarter to the fourth that we're back in recession, not from that standpoint, Mr. Burry, but perhaps we need to dig deeper. Sign Asset Management founder Michael Burry said while inflation has peaked, it is likely to pick up again in response to government stimulus. And so I want to bring up a key point here. What he's saying is that it's likely inflation is not going to go any higher than it already has, but it doesn't mean we won't see another move higher in inflation at some point. But let's take a look and see first if we can figure out if inflation has indeed peaked. And for that, we have to head over to the St. Louis Fed, who've got the consumer price index. Now we're going to look at this chart in blue, and we're overlaying it in red with the University of Michigan inflation expectations data. And we know that inflation expectations, what the consumer sees in terms of prices, is a good barometer for where inflation is headed. And sure enough, as you can see, periods where inflation expectations are falling, we note that with a lag, we see the consumer price index head lower. You can see that here in the 80s. You can see that happen again in the 90s, in the early 2000s. You can see it during the financial crisis. You can see it post-financial crisis. And this makes a lot of sense in terms of why does it happen with a lag? Well, it's not because everyone drops their prices at the same time. That doesn't happen. But we know that the government data, it comes out with a lag. So it takes a while for the government, takes months to go by before they finally figure out that inflation is coming down, making the consumer an excellent barometer. But what is driving the consumer sentiment? What is it they're seeing? Well, so signs on the corner of many called a gas station. And here you can see now when we overlay U.S. regular all formations gas price in green against inflation expectations still in red and the consumer price index still in blue, what we can note is that, of course, gas prices tend to lead inflation expectations. And sure enough, we see that, again, making that price you see at the pump the best indication of where inflation is going. So if you see it heading down, then you know inflation expectations are coming down, and then you know the CPI is coming down. If you see it heading higher, well, then you know the opposite is true. But that's not the only indicator we can look at. We also need to look at import prices. In fact, from one of our favorite places we like to cover on the show, and that's from China. And the reason we look at import prices from China is because the U.S., well, by design of the global monetary system with the dollar as the global reserve currency, we import deflation, export inflation. So what we should see is import prices by origin from all industries in China. That is heading down. That will also help lead the consumer price index lower. And so what that tells us now is we go back to Burry, is the U.S. in recession by any definition? He says, well, not by any definition. Fed will cut, though, and government will stimulate, and we will have another inflation spike. And I think that's kind of what he's starting to tell us, and we're going to look at the actual tweet in a moment, but what he's suggesting is, look, inflation may have broadly peaked, and it appears that it's coming down, and everybody's getting excited, and perhaps even the Fed will get excited that it's coming down, but he's saying, look, it's not over. There's going to be likely another move higher in inflation before this is all done, and that's coming later this year. Inflation peaked, he says, but it is not the last peak of this cycle. Key words of this cycle. He says we're likely to see the CPI lower, possibly negative in the second half of 2023, and the U.S. in a recession by any definition. Fed will cut and government will stimulate, and we will have another inflation spike. It's not hard. Now let's pull this apart before we get into the charts. He's saying we're likely to see deflation in the second half of the year, which means the Fed has over-tightened. We'll have to dramatically cut rates, and that leads to a dramatic fall in interest rates. But as we've talked about on recent shows, it's the gas prices that matter. And by summer, why is he saying this? By summer, the year-over-year comp in gasoline prices, unless you see a big surge of pump prices, is going to be negative. That will lead the CPI lower and, of course, inflation expectations. But now let's put to this challenge of this double peak or the second move higher. This will be a second transitory move higher in inflation. And Burry is right, because when we look at the consumer price index, again, we're going back, it's in blue, and now we're going to look at the federal funds rate, because he said the Fed is going to cut and the government will stimulate. Now, I do want to put a kind of an asterisk on this. It is unlikely we will see the massive amount of fiscal stimulus we saw during the pandemic. It was probably over, but some believe it isn't. But we'll just say for the moment that they're going to stimulate, but not in that fashion. And so here you can see there's a case where the Fed in blue, or not in red, starts cutting the funds rate, and you see a move higher in inflation here in around 1990, and that pushed inflation up. You see happening here after 1995, the Fed cutting rates a bit, inflation making another move higher. You see it here in early 2000, the Fed starts to cut, inflation makes another lagging kind of move higher before it falls. You see that during the financial crisis. You see inflation was coming down, the Fed paused, and then it shot higher. You see it even here going into the pandemic. Inflation came down, the Fed was starting to cut, inflation popped back up, and then the pandemic hit. So based on the data that we can see, Burry has got this absolutely right, that there's likely another peak of inflation. Doesn't mean we're going to see a new all-time high of the cycle in inflation, and that's not what he's suggesting. But is there something we can look at that might give us a clue? And we'll start by looking at the 10-year, 3-month yield curve and see if we can find something in that. And the answer here is there's nothing in this that tells us about that second peak, because when we see the yield curve steepening, well, what we know from a macro perspective is the yield curve, when it's steepened, tells us inflation is coming down. It doesn't mean it's coming down in a linear fashion. It just means the trend, when it goes up, is that inflation will head down. But you can see in all of those instances, the yield curve was steepening, and what happened, we still saw a transitory rise in inflation before the yield curve came true and drove inflation back down. So the question we should be asking ourselves is, where does this second spike of inflation come from? Why does it come from the Fed? Why does it come from stimulus? And we can come back to what we said earlier is the price at the pump. And now we can see that what we note from the data going back to 2000, there was a bit of a spike higher in gas prices before they came back down. We know, again, these are on a year-over-year rate of change, so keep that in mind. Look at here going into the financial crisis, same thing happened. We can see that right here going into another move higher of inflation, and you can see it again right before the pandemic. So why, of course, does government stimulus matter in this case? Because what do people consume when they get money or financial conditions ease? You look at this from a stimulus standpoint, it's energy. In September, Burry had warned more pain for the stock market, saying we have not hit bottom, which was making the call for me that this will be the year of hell for investors. In the second quarter last year, his firm dumped all of his equity exposure besides one company. Now, why is he suggesting that? Is because when we take the total stock market, in this case, the U.S. stock market, which is the Wilshire 5000, against the federal funds rate, that will be in red. What we can note is the market doesn't bottom until the Fed gets near near to whatever the market perceives is the bottom of its cycle. And you can see that every time that's about where the market bottoms. So if he's suggesting that we see deflation into next year, means the Fed cuts, and that is actually bad news for the market. Doesn't mean we can't see a move higher in stocks in the interim, but what he's saying, we don't see a bottom until later. And now does that tell us that the yield curve is validating this move in stocks or suggested move in stocks? Yes. Here again, we see the Wilshire 5000 in blue, now overlaying the 10-year Treasury minus the 3-month Treasury yield curve in blue. And what do we know? That, of course, periods where the curve steepens, you typically get kind of an initial spike, it comes back down, and then the curve spikes again. That's where you get the bottom. You see it here again in the financial crisis. The yield curve spikes, it comes down, has a second spike, and into that second spike, the market bottoms. Now you're saying, well, we didn't have that happen this time, Steve, and you're right. And why did that happen? It's because the government loaded people's pockets with money. And what did they do? They bought stocks. It changed the cycle. So we'll have to keep in mind, if that happens again, then we'll see the same thing we saw during the pandemic. If we don't, we're likely to see the double spike in that yield curve, indicating that the bottom in stocks is finally in. Federal Reserve Chair Jerome Powell last month said the central bank is not close to ending its anti-inflation campaign after raising its benchmark rates 50 basis points, but the yield curve says, no, Fed Chair, you're wrong. And sure enough, here we see the federal funds rate, this time in blue, against the yield curve, that 10-year 3-month in red. And what do we know? The yield curve, when it's inverted or near inverted, where I've got it marked here, matches perfectly with where the Fed tends to set the peak rate. Now, it doesn't mean they said that's the peak rate. It just means that is where they end up stopping because the market tells them otherwise. You can see it here again around 2007 or so, and then around here again in 2019. So all the data now suggests that February 1st, when we know the next Fed meeting is coming, that not only has Powell said he's raising rates, but the board has said we're going to have projections that mean rates are going up. The market's saying not a chance. But if Burry is right, and there's a good chance he is, from an investor standpoint, 2023 is going to be the year from hell. And with that, I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.